Today's topic, I think, is very interesting. It's about navigating the high interest rate environment and how you can still get cash flowing rentals with the 8% interest rate environment that we're in.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param Baladandapani. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
I think, it's a very unique time, especially compared to the last few years, because on the one hand, interest rates are staying high. They're, on average close to 8% about the time that we're doing this live. And on the other hand, single family homes. Now, in the multifamily space, prices have dropped. I think in most markets, we're seeing a 10 to 15% correction since the market highs that we saw last year. But in the single family space, prices haven't necessarily dropped similarly, right? You will see maybe a less than 5% drop in prices in most markets that are strong. And a lot of that has to do with the fact that a lot of homeowners right now have interest rates locked in really low, and they really don't have any incentive to move out of it, right? And so with the high interest rates and prices not having dropped, it's almost a double whammy. And as an investor learning about real estate investing, it's very natural to struggle to find properties that make sense because you're always running the numbers, right? And the numbers need to make sense. And I'm sure a lot of you are thinking about, waiting on the sidelines, waiting for interest rates to drop before you can start investing again. I hear this all the time. And this episode, this topic, this discussion today, what I wanted to do is I wanted to really tackle this head on and talk about 4 strategic shifts you can make in the way you're investing to enable you to still invest with in the current environment and still have cash flowing rentals, right? Because the way I look at it, and obviously there are multiple ways of looking at it, but I firmly believe that as rates start dropping, more and more buyers will be able to get into the market. And that's true in the single family space. That's true for the first time home buyer also, right? And with that, prices are going to start going up again. And for an investor, you're not as concerned about interest rates or about home price as much as you are about mortgage payments. And so as rates drop and prices start going up, you're going to notice that you're going to be in a similar position, right? So let's start by taking a look at, before we deep dive into the 4 different ways, the 4 strategies that our students within our coaching program are using even now to purchase cash flowing rentals, even in this market. Let's take a look at a scenario, right? Just to have like a baseline number to understand how much the market has actually shifted. If you take a look at a home that, traditional, I say in each market, there's a sweet spot for the price to rent ratio, right? And so let's consider the Bakersfield market, which is where I'm from today, as an example. And typically a rental property that's about $400,000 in cost it's usually a good rental property. All right. It is at that point where rents are typically about $2,500 on the lower end, going all the way up to $3,000, right? And so it's a good ratio for where numbers made sense in the past. And so if you put $100,000 down in let's look at numbers in a 4% interest rate environment versus an 8% interest rate environment, right? In the 4% interest rate environment for that property with 25% down, your mortgage payment was likely about $1,400, okay? In the 8% interest rate environment, now suddenly your mortgage payment is about $2,200. So that's a huge shift. That's $800 more, right? So what does that do to you as an investor? Now, assuming this property had an income of $2,500 per month and operating expenses, that's property taxes, HOA, insurance, the things that, you're always going to have are about $800. That gives you a net operating income without factoring in your debt payment, right, of about $1,700, right? And if you were in a 4% interest rate environment and your mortgage payment was $1,400, that 1700 still made sense, right? You were still cash flow positive. But if with the interest rates at 8%, you're now at 2200 and your net operating income is only 1700. So you're negative $500 every month, and that's $6,000 a year. So now you will have on your hands what, if you ended up buying this and you don't really run your numbers, you'd have what we call an alligator, right? A negative cash flowing property that's sucking money from your pocket. It's not necessarily moving the needle anytime soon towards financial freedom for you. So, what can you do? There are the two things. You can change your terms and your strategy. We'll talk about strategy shifts, for pivotal things you can do to still cash flow in this environment. But I think it's also important for us as investors to have a shift in terms of our what our terms are, what we expect from a property, right? I have a friend who's been investing locally in Pennsylvania, and they self-manage, and typically they were at about an 8% cash on cash when they purchase properties in their neighborhood, right? One of my really good friends. And today they're probably at a 3% cash on cash when they end up buying those properties. And they're I'm noticing hesitance, but again, I keep telling them you have to pivot and shift. Right now, that's a pretty decent number. You're breaking even, you're cash flow positive. You do well even if you have a buffer in that property, and it's time to change your terms, right? Change how you look at what you expect that cash on cash to be. So that's something we all need to do. And then we have the strategy shifts, which hopefully some of you can apply. But I think the other thing to think about from a broader perspective right now is this is also, and a lot of our members, even within our coaching program, have pivoted to investing directly and investing through syndications. And the reason is when you're investing passively in a syndication, as operators, we go in, we purchase properties that are discounted already. We're able to go in and use a lot of the strategies we're going to talk about, those four strategies. Someone's already going in and doing the work and giving you the opportunity to invest in something where you're able to take advantage of the tax efficiencies of real estate, and you're still able to get double digit returns even in this environment, right? So those are the two pivotal shifts I think most people need to think about. Change the way you look at your terms for investing, and then adding on syndications may be a way for you to continue to invest in the current environment. But that being said, we constantly have opportunities for those of you looking to invest passively. Our current offering, there is still some space on the wait list. So if you want to check it out, go to generationalwealthmd.com/Atlanta3, Atlanta in lowercase, and you will see our deal webinar where we educate you on in terms of what the risk reward profile looks like. You can learn more and you can soft commit over there. But without spending too much more time on this, let's now deep dive into the four strategies that you can use as an investor and still make sense of the numbers and still purchase cash flowing properties. So the first thing I want to talk about is financing, right? So there's always the debt and the deal, and both of them are equally important. And while we tend to focus so much on the numbers and how much we can increase the rents and what the purchase price is, financing is something that, especially in the current environment, there are so many strategies to change the kind of financing you're acquiring to be able to then have a property that is cash flow positive, right? So let's talk about a few of those strategies that a lot of our students have been using. Subject to loans is an important one. This is where you are going in and you are taking over payments on an existing mortgage that is likely at a sub 4% interest rate, right? So you get better rates. You may be able to, and oftentimes this is a seller who is distressed, who needs to really, get this property off their hands. You may be able to negotiate a discount. You likely will go in with a ton of equity in that property. If you listen to the most recent 3-day live, Mary talked about subject to. That's a strategy that she used to acquire her last rental. So it's a way for you to lock in better rates and get built-in equity into a property and purchase a property at a discount. So the numbers can still make sense even in this market, right? So that's one way to do it. Seller financing. Now, some of our students talked about seller financing the last time we had our 3-day event. And that's a strategy where if you have 40, and these are the statistics, about 40% of owners in this country don't have a mortgage on their property. And so they can actually serve as the bank and they can lend you the money and you can structure it in a way where you can either go in with a lower down payment or lower rates. You may even be able to go in and for the first few years have an interest only term where, because you aren't paying the principal portion, you have a lower monthly payment and you are then cash flow positive, right? So you may be able to lock in a better rate where the numbers start making sense. That interest only period can make the numbers become attractive again where you're cash flow positive. So that's something else to think about in the current environment. Seller financing, having your seller, and oftentimes this is not something that they come up with. You have to actually have discussions and get them to the point where they are willing to finance the loan, be your lender essentially, because it makes sense for both of you, right? So seller financing is another way to have the numbers make sense. As far as interest only loans, that's the other thing you can look at in terms of financing. When you get a HELOC on a property, right, and you're using that for a down payment, you can have an interest only period. With commercial loans, you can go in and have a period of interest only where it gives you a buffer, right? It gives you 2 years, 2 to 5 years, where you can go in and just make those interest payments. And so you have a lower payment. Overall, you're cash flow positive, and that gives you time till the interest rates start dropping, or you're able to increase rents either because of market rent growth or because of going in and adding value to the property, right? Same thing with private lenders. You may be able to negotiate interest only periods. So that's another way to get creative with financing to have the numbers still make sense for you. And then the last thing I want to touch upon in terms of financing is going in with a higher down payment. Now, you'll sometimes, if you are in a position to do this, you may be able to go in and pay all cash for a property. And then you have, oftentimes you're at about a 5% cash on cash return or cap rate at that point when you paid all cash. And so the property will cash flow, right? Almost any property will cash flow if you're paying all cash for it. And so the disadvantage to that is often that you really aren't able to take advantage of leverage, and you aren't getting that leverage multiplier even when the property starts appreciating in value. But that 5% that you're seeing in cash flows only return from cash flow. Now, you may be able to tap into tax strategies where you're really boosting your returns because purchasing that property gives you a tax break, especially if you have real estate professional status or you're using one of the short-term rental strategies where you can shelter your clinical income from taxes. So it may not be just that 5%. But even if it is just the 5% and you're not able to tap into those advanced tax strategies, you still have on average about 3% from market appreciation, in most markets. So you have an 8% average annualized return from that property. Now, that isn't super attractive because it brings the returns down. It drags the returns down into the realm of what you can expect with the stock market. But I think it's still another way where you can get into real estate. You can refinance at some point and pull out your equity, right? It does give you an upper hand with negotiation. And sometimes I say, don't think about it just in terms of that one property. If you have, say, 4 properties and one of them you've paid for all cash, then across your portfolio, you may still be at a 60 to 70% LTV, loan to value, leverage, right? So think of it from a holistic perspective, and sometimes it may make sense to even do that, right? So that's as far as financing. That's the first of the strategies. What else can you do? The second thing you can do is add value to your property. Now, this is your typical BRRRR strategy. I've talked about this in the past. That's when you buy, you rehab. That's a BRRR. 4 R's. Okay, so buy, rehab, and then you refinance the property. You've increased the value of the property by doing the rehab. You do a refinance, you pull out the equity, you then rent the property, and you can rent it for a higher price, and then you repeat the process, right? So that's the typical BRRRR strategy. Now, that $400,000 property that you could rent for $2,500, if you did the BRRRR strategy, and this is where you really have to run numbers before you go in. But if you did it right, then you can get up to $3,000 in rent. And now you have a property where, not only have you built in that equity, but you have a higher rent because you're able to rent it for a higher rate, and your numbers suddenly start making sense, right? So that's the second one. The third thing, what else can you do in terms of shifting your strategy? Running your property as a short-term rental or a mid-term rental. And I talk about this often too. A lot of our students within the coaching program are doing this. And sometimes, especially if it's in a metro market, you have the ability to shift from a furnished long-term rental into a mid-term rental or a mid-term short-term rental combo. And that $400,000 property that would possibly give you $2,500 in rent as a long-term rental can suddenly, when it's a short-term or a mid-term rental and you've run it and you're running it effectively, right? Again, I say that's like running a business, so you really need to know what you're doing. But when you are doing it right, you can double to quadruple the rent you get from that property for that $400,000 property, and suddenly the numbers begin making sense again, right? So that's another way that you can really increase your income, thereby be able to still invest in the 8% interest rate environment. And finally, the fourth strategy is to purchase properties at a discount. Now, that may sound a little crazy given the environment we're in, but we are still seeing people, in the single family and multifamily space who are able to go in, and this may be through a wholesaler where they find distressed sellers. This may be finding distressed properties in other ways, like foreclosed properties that are getting close to foreclosure, properties that are being auctioned, right? Where and this is true even in the multifamily space. Operators where they have really bad debt and the debt is stressing the deal and they need to really offload the property, and they are upside down in the property, so they may need to offload the property. There are multiple ways to get a discount even in this market, and when you do that, getting that discount lowers your mortgage payment and the numbers start making sense again. You could even do this when you're and this is almost similar to the value add strategy where you can add an additional bedroom and a bath and then thereby increase the rents. And so looking at hidden properties with hidden value, that's something else to think about, right? So those are your four core strategies that you would use even in this market, that our students are using even in the current market, to be able to find properties that make sense. That's what we're doing when we're investing, when we're underwriting and bringing you these deals that we in the multifamily space with syndications. And so you really need to change the way you're thinking about investing right now. So you change the terms, your terms, right? I want to get a 10% cash on cash on a long-term rental that is a turnkey in a strong hybrid market. Not necessarily going to work right now. So changing your terms, being a little more realistic. You still want to buy properties that are break even or cash flow positive, but being more realistic, changing your strategy. We talked about four core shifts in strategy that you can make. That's super helpful. And if that feels a lot overwhelming, then investing through syndications, investing passively, because as operators, we are going and finding discounted properties. We are going and using creative financing. The last few deals we had, loan assumptions, which is similar to a subject to, right, where we were able to get sub 4% interest rates. We go in and we add value in these apartments by doing rehabs, and we have economies of scale obviously, but when we do that, we're increasing the rents, and the numbers are making sense. There are those tax efficiencies that we talk about built into investing even passively through real estate syndication, so you still continue to get double digit returns in a de-risked property, right? And so for anyone looking for those opportunities, our current offering is in Atlanta. Again, a very strong market. It's Stewart's Mill, fixed interest rate, de-risks at 94% occupancy. Definitely check it out. It's generationalwealthmd.com/Atlanta3 in lowercase, Atlanta in lowercase. And we have a deal webinar over there. The last date for soft commit was the 5th of November, but we still have some space. And so you can get on the wait list and you'll be notified as soon as we are in a position to have you start signing the documents. So again, that's generationalwealthmd.com/Atlanta3 in lowercase. So I highly recommend. I don't think, again, like I said, I don't think this is the time to be sitting out, because as soon as rates start dropping, which could be sometime next year, we will start seeing more people in the buyer's pool, again, driving rates up and more competition. And as an investor, you're looking for numbers that make sense, and numbers do make sense even in the current environment when you use any of the strategies we just discussed. So definitely highly recommend not letting that momentum slow down, but try to be a little more creative in terms of how you're looking at things, and always feel free to reach out if you have any questions.